Welcome to this explainer. Today we are unpacking a seriously complex, parallel pipeline that makes up our modern financial world. We usually think of money moving in just one highly visible direction. But as we're going to see, the global financial system actually casts a massive shadow.
For most of us, this system seems, incredibly straightforward, right? You deposit your paycheck, and you totally expect the bank to safely hold it or maybe use it to underwrite a local mortgage. It's the standard, familiar mechanism of credit that we've known and relied on for absolute generations.
Section 1. The familiar financial system. Okay, let's dive into this.
Let's actually trace how that traditional pipeline works. So it starts with everyday depositors parking their cash. Banks act as this vital bridge, aggregating those deposits and transforming them into loans. Those loans then flow outward to businesses and consumers who, need capital to expand their operations or maybe just buy a car. The traditional bank sits right in the dead center, anchoring the entire process from start to finish.
Banks are basically the great mediators here. They collect deposits, provide credit, process payments, and manage lending risks. So this is exactly where the money for your home mortgage or a business credit line traditionally comes from. But here is the really crucial insight. Because they rely on our everyday savings, they are heavily regulated. Governments provide deposit insurance and central banks act as lenders of last resort. Why? To ensure that when a bank takes on risk to fund a business, a bad bet doesn't just wipe out a community's life savings. It's a really neat, self-contained ecosystem engineered for stability and bounded by some pretty strict capital requirements.
Section 2. The hidden second pipeline. Over the past several decades, an increasingly important part of the credit system has developed entirely outside traditional banks. The story of credit has grown so much more complex. I want you to imagine a completely parallel universe operating right next to the familiar traditional system we just talked about. Literally a second financial pipeline running quietly alongside the first. And we are not talking about some tiny niche market here. This parallel system manages tens of trillions of dollars globally. It's expanding like wildfire and now rivals traditional banks in sheer scale and economic impact.
Now, what's really interesting here is the brilliant symmetry with the first pipeline, but with one crucial difference: the funding source at step 1. Instead of everyday depositors starting the chain, this new pipeline is fueled by institutional investors. Think pension funds, insurance companies, and university endowments that are just constantly searching for higher yields. And rather than traditional banks acting as the middleman, specialized funds and non-bank lenders step in to route that capital. The ultimate outcome is exactly the same. Credit flows out to businesses and consumers, but the engine powering the whole shebang has completely shifted from Main Street checking accounts to global Wall Street capital. So who are these parallel players? Well, they include investment funds, private credit firms, specialized finance companies, independent mortgage lenders, and other non-bank institutions. Make no mistake, these are absolutely not traditional banks. Unlike a local bank manager who is bound by super strict federal capital requirements that totally limit how much risk they can take on, a private credit firm operates with immense structural flexibility. They can move way faster, underwrite unconventional risks, and easily structure really complex loans for, say, a rapidly scaling tech startup or a massive corporate buyout, loans that a highly regulated traditional bank would simply be forced to reject.
When we contrast these two worlds side by side, it reveals a massive shift in modern finance. On one hand, you have traditional banks, which are funded by and constrained by the steady but heavily regulated nature of consumer deposits. On the other, the parallel system channels huge pools of institutional capital directly into the credit markets. And this matters, big time. It dramatically increases the speed and volume of available credit, injecting liquidity into the economy way faster than traditional banking ever could. But it also fundamentally alters the risk profile, tying everyday consumer and business loans to the sometimes volatile swings of global capital markets.
Now, you might have heard this parallel system referred to in the headlines as shadow banking. It's a pretty dramatic term, right? And it's precisely why regulators often view it with a lot of anxiety. They inherently fear what they can't easily see or control during a panic. But actually, a more precise, objective term is non-bank financial intermediation. The institutions in this space rightfully point out that they aren't literally hiding in the shadows at all. They are innovating. They're performing bank-like functions without the cumbersome legacy structure of a bank, effectively modernizing and streamlining how credit reaches those who really need it most.
Section 3. The big unanswered question. Let's bring these two interconnected channels together to see why this dual system reality matters to us.
Because the reality we live in today isn't a world of two isolated systems. It's a single, massive financial ecosystem with two deeply interconnected channels.
And the question is no longer just who is lending the money, but understanding how these two interacting pipelines function as a whole. The linkages between them are structurally vital. Believe it or not, traditional banks actually provide massive multi-billion-dollar lines of credit to these very non-bank lenders just so they can operate. They also invest heavily in the exact same financial assets. This means if a shock hits the parallel system, let's say a sudden wave of commercial loan defaults, it doesn't just stay neatly contained in the shadows. That counterparty risk bleeds directly back into the traditional banking world. Basically, a liquidity crisis in institutional private credit could suddenly and very really threaten the stability of the heavily regulated everyday banking sector.
Which leaves us with a totally pivotal question as this financial landscape keeps rapidly evolving. What happens when more and more of our global credit moves entirely outside the heavily safeguarded traditional banking system? And most importantly, when a crisis hits and the pipeline sees up, who acts as the ultimate backstop for a system that was, built to avoid regulation in the first place? It's really no longer just about who is lending the money, but whether our modern economy can safely handle the shadows it has created